Hey guys, welcome back to the channel. It's Pete. This is where we talk about money, finances, where we give you information and education to help you make the best financial and investment decisions possible. If you're using Trading 212 right now and you've tried to use them to buy an ETF, you're probably looking at the app thinking, this is not helpful at all. Because unlike the share side or the stock side of what they do on the app, where they give you information about the company, they give you some financial data, the ETF side, they don't do any of that. And I'm going to show you what I mean. So this is the Trading 212 app. And if you go onto the search tool here, you go ETFs. I'm going to choose the most popular 10. And I'm going to choose the Vanguard S&P 500 ETF because it's very, very popular as an ETF, right? Yes, you can see like the graphs in terms of how it's performed. You can see that the market is closed. That's fine. But if you go into history, there's no information. If you come out of that and go into instrument details, all you're presented with is this. And it's not a lot of information. It's not going to allow you to get under the bonnet to understand what it is that you're buying, what it is you're putting your money into. So in this video, I thought I'd address that. I'm going to talk you guys through how you can do some further research to make sure that you are able to get information to empower your decision, to make sure that you are, in fact, buying the right ETF for you. I'm also going to cover some really basic stuff as well that are important considerations when you're looking to pick an ETF. If you're new to this channel, welcome. This is where we talk about investing. We use plain English. It's all about empowering you. So if you're not subscribed already, make sure that you do subscribe, smash that like button. It will help me out massively with the YouTube algorithm, and hit that notification bell because I upload every Tuesday and Friday, and you'll get notified when I set the video for premiere. All right, so let's talk about some basics. I have done a video where I talked about ETFs in conjunction with an index fund and a mutual fund. It's really important that you understand what those three things are because they are all viable investment vehicles if you're a first-time investor. In fact, they're great things that even experienced investors use. So I suggest you go and watch this video right here. That will give you the information that you need. But I'm going to cover some of the basic important stuff about an ETF here so that this video makes sense and you're able to follow what we're going to be talking about here. So what is an ETF? An ETF is an exchange-traded fund. So in other words, it is a fund that is traded on an exchange. An exchange will be the London stock market or the New York stock market. So essentially, it's traded on an exchange. Now, there are some really good advantages to using an ETF. They're very cost-effective ways of investing in the market at a really reasonable price point. I mean, you can have a look at some of these at 0.07%. Some of them up to 0.12, up to 0.25. So these are very reasonably priced compared to some of the other options that are out there on the market. Another reason why ETFs are great is the fact that because it is traded on an exchange, unlike an index fund where you have to wait until the end of the day to sell your position or close your position, you could trade your ETF, sell your ETF at any given time during the day, as long as the market is open. So for example, if at 11 o'clock you needed to get your money out, you could literally trade, get out at 11 o'clock in the morning. Very, very different to an index fund. It's one of the big benefits that you get from using an ETF. The last one I'm going to talk about is the fact that with an ETF, it is essentially a mechanism that allows you to mirror the performance of an index of some kind. So an index might be the S&P 500 in this example that I'm going to be using throughout this video. So the S&P 500 is essentially the US markets, the top 500 companies in the US. So you'll be mirroring, tracking the performance of the S&P 500. And what that means is because you're tracking 500 companies, you are essentially stacking the odds in your favor because with 500 companies, you're more likely going to have 300 do well than relying on a handful of stock that you've picked out yourself to perform. You've given yourself more chance and more diversification. You're managing and spreading your risk a little bit more across 500 companies as opposed to just 12 companies. Now, because an ETF essentially tracks the performance, if the S&P 500 goes up 10%, you'll see that mirrored in your ETF. If it goes down 5%, you'll also see that mirrored in the ETF as well. But it's a great way to access the market cheaply. It's a great way to get some really good diversification, and it gives you a bit more freedom, flexibility of your own, knowing that you can exit as long as you have an open market at any given time during the day. With that being said, what are some of the key things that you need to be aware of or need to be researching, or things that you need to pay attention to when you're researching to ensure that you are picking an ETF that is going to be right for you? So ETFs come in all kinds of different forms. So you can have an ETF that tracks an index, so the S&P 500 or the FTSE 100 or the FTSE 250. You can have ETFs that will track things like gold. You can have ETFs that will invest in bonds, those kind of things. So you need to understand how you want to invest first and foremost, because that's going to dictate what kind of ETF you pick up. Are you going to pick up a FTSE ETF that's going to give you exposure to the UK? Are you going to pick the S&P 500, which is going to give you exposure to the US markets? Are you going to pick gold because you want to be invested in gold, but you don't want to go and buy physical gold? All these questions are really, really, really important to understand. In this example for this video, like I said, I'm going to be using the S&P 500 ETF from Vanguard as the example, and I'm going to show you where you need to go. So typically, if you are going to be identifying what ETF you're going to use, it's going to be built by somebody. So in this example, this one's built by Vanguard. So the most reliable place that you can go to for information will be the Vanguard website. And I'm going to hop onto my computer right now. So this is the Vanguard homepage. And we already know from looking into Trading 212 that you have an ISIN number, or you can simply just use the name of the ETF. And we know in this example, it's the VUSA ETF, and there it is right there. So let's click on that. And here you're going to get all the information that is pertinent about the ETF. Now I'm going to run through very, very quickly with you some key things to pay attention to. So you've got some headline figures right here, the number of stocks that it's invested in, the ongoing charges figure, which is 0.07, so really, really cheap. But you've also got on here the risk element to this ETF. Now, they score out of 7. So 5 out of 7, you could argue is a little high risk. So as an investor, you need to make sure that this meets your personal risk appetite in terms of how you're actually investing your money. I talk a lot about this in the investment course because this is a key consideration. If you're a balanced investor, you don't want to be investing in something that is more adventurous than balanced. You need to make sure that you keep yourself in that same line as your natural inclination, depending on obviously how long you're investing for, what your investment goals are. But this tells you here with Vanguard that it's rated a 5 out of 7, so it's a little bit more adventurous. Then you've got some objectives. So what's important here is the language. So the fund employs a passive management or indexing investment approach. And what that essentially means is that it isn't being managed by any particular team. It is simply going to track. So it is set and it will just follow the performance of the S&P 500. If the S&P 500 goes up, it will also go up. If the S&P 500 goes down, it will also go down as well. And also here, you've also got the fund objectives actually written out here, and the fact that it is there to track the performance of the index by investing all constitute securities of the index in the same proportion as well. And, it will remain fully invested except in extraordinary market, political, or similar conditions. And what they're basically saying there is that, if there were to be another recession, they could essentially make some changes to the ETF to make sure that clients, investors, don't essentially lose money. Now, one of the things that I do want to really kind of, highlight is this. It is ISA ready. So if you hear me speak, I always talk about the fact that, ISAs are the best place to go. So you can invest in this ETF and keep all of your returns completely tax-free. You've got the inception date here. You've got the investment structure. Now, this is domiciled in Ireland, and I'm going to talk a little bit about domicile in a moment because domicile is very, very important. Where the ETF is domiciled has huge implications in relation to the tax that you're going to pay. So ETFs that are domiciled in Ireland also benefit from double taxation. And this is where if you're getting dividends, for example, within your ETF, then ultimately the government in America will charge you 30% on any dividend payments that you receive. With it being domiciled in Ireland, you can basically benefit and reduce that from 30 down to 15%. So where it's domiciled is very, very important. Most people, if you're in the UK, will look for an ETF that is domiciled either in Ireland or in Luxembourg. But Ireland definitely gives you more favorable tax treatment. Now, total assets, 23.8 billion. And this brings a really important point to bear. If you're looking for an ETF, the size of the ETF is important because the bigger the size, the more interest you're going to have in the ETF, which means that at some point you're going to want to sell. You're going to have more willing buyers. It means that the value of the ETF fund itself will remain consistent because, or has the ability to grow because there are people who want to actually get into the fund as well. With a bigger fund like this, it also means that they're less likely to fold or close down because there hasn't been enough interest in the fund. So where you can, it's always a good idea to look for an ETF that has a big total asset base. It means that they've got track record. It means that there's demand. It means that they're not just going to close down overnight just because there have been outflows or maybe not enough interest in the fund. So really, really important for you to consider. Let's just go back very quickly though. I'm going to have a look at pricing. So pricing is very, very important. So obviously with this ETF, the OCF, so the ongoing charges figure is 0.07. Now, when you're buying an ETF, yes, the OCF is important. However, one thing that is also worthwhile bearing in mind is that whenever you try to exit or buy into an ETF, there are also going to be costs. They're called transaction costs. So it's very, very important that you also take into account any additional transaction cost that might come along with the ETF as well. And the best way that I can describe this is that, if you are going to be in a position where you want to sell it at 10 o'clock tomorrow morning, well, you're going to have a bid price and you're going to have an offer price. I'm just going to explain briefly what those two things are. So the offer price is the highest amount that you would basically pay to buy into the ETF, whereas the bid price is the highest amount that you would sell it at. And oftentimes what you'll see is that an ETF is trading at a certain number and the bid and the offer prices will have a little bit of margin, a little bit of a difference in the actual trading number. And that's called a spread. So the spread is essentially where your broker tends to make a little bit of money. It's very, very important that you factor in the cost of that spread as well. Now, that can be hard to do because, like I said, as the value of the ETF in terms of its trading value changes, the spread will also change consistently as well. But one of the best ways that you can, go about finding what the bid and the offer prices are for an ETF is to go onto the London Stock Exchange. Here it is right here. And you can see that the bid price currently at the moment for this ETF is £50.85. The offer price is £50.87. So that little bit of a difference, it looks relatively small, but it can add up, is essentially a spread. And that's really the cost of you actually executing the trade. It's a transaction cost. People need to factor that in to the ETF buying process because that cost will be added onto the OCF. So another thing that is worthwhile bearing in mind when you're looking to purchase an ETF is, can you get an ETF that is dominated in your own currency? This may seem pretty nonchalant, but it's actually very, very important because if you're buying an ETF and it's being converted into US dollars, not only are you going to be charged a transaction fee for conversion of your currency into the USD, you also have to bear in mind the impacts of currency rates and currency fluctuations when you sell your position ultimately. It's just one other thing that you need to think about. If currency is down or the currency isn't doing too well, then potentially it can have a little bit of an impact on your overall returns. So the currency in which is dominated in should be a key consideration for you. If you can get it in British pounds, great. But sometimes you're going to want to buy an ETF where you don't have any choice but to buy in a foreign currency. You might want to buy in the yen if you're looking at something in China. If it is in the States, for example, where we're using the S&P 500 here, it may be that you have to buy in US dollar. But bear in mind that you're going to have that transaction cost in converting from British pounds to USD, and potentially you might have an impact on the currency rates as well when you finally do sell your position. So doing your research on an ETF is really, really important because you do kind of need to know what's actually in there. And I'm just going to go back very, very quickly to the Vanguard website. And I do want to show you this. I want to show you the tab which talks about portfolio data. So clearly it talks about the number of stocks. It gives you the median market cap of the companies that are on there. It gives you the return on equity. It gives you some really good information that you need to know. You've also got the region, so it's North America, which is essentially the states. But what I do want to come down to is, your weighted exposure. So where is this ETF actually invested in terms of sectors? And what you can see here is that majority of this ETF is weighted in the tech industry. So, you're looking at Apple's, you're looking at Facebook, you're looking at Tesla. It holds 27.4% in the tech sector alone. And you've got healthcare, you've got consumer discretionary, communications, financials. And once upon a time, financial would have been top, but this is how the world has changed. Industrials, consumer staples, utilities. You need to know this because you need to know where your money is being invested. And if you have a bias towards the tech sector, for example, this will give you really good insight to understand, well, actually, you're putting your money into something that believes in the tech sector and is invested in the tech sector as well. So these things are very, very, very important. You also have the holding details. So what are the top 10 holdings? And as you can see, there are popular names here that we know. You've got Apple, Microsoft, Amazon, Facebook, Alphabet. You've got different kinds of class shares in Alphabet here, Class A and Class C. Berkshire Hathaway, which is Warren Buffett's company. Johnson & Johnson, Procter & Gamble, NVIDIA. And it tells you how your portfolio is split across these companies. Now, this is only the top 10 holdings. There will be more than this, but you're getting a view of what kind of companies they're holding, companies that hold the biggest weighting of your money. So for example, in Apple, 6.45% of your money is held in Apple specifically. Most times when they're building ETFs and they're building funds, they don't typically like to have more than 10% at any one time in one company because they're looking for diversification. They want to spread your money amongst as many companies as possible. This is only the top 10, but it gives you a really good insight into the kind of companies that they're holding. And this kind of stuff is really, really important to pay attention to. I'm just going to show you another site which is very, very worthwhile you bearing in mind, which will help you do a little bit of research when it comes to selecting an ETF. It's called justetfs.com. This will give you some very fundamental information. It will give you the fact sheets as well. But all of these tools are designed to help you make the best decision possible. Research is key. You have to know what you're buying, guys. Just buying something just because everybody's buying it now doesn't mean that it's going to be right for you. You need to make sure that it matches your goal. You need to make sure that it matches your risk appetite. Look, let me know what you think in the comments below. Did this cover enough for you? Do you want to see more of this kind of video on ETF specifically? Let me know. If I get good responses in the comments, I will make more of these videos. But as ever, I thank you so much for being here and paying attention. If you do want a free share in stake, there is my referral code down in the description. They are giving away a free share in either Dropbox, Ninth, or GoPro up to £100. You have to fund your account within 24 hours of opening your account with £50. So if you deposit £50 and you manage to get a stock worth 100 quid, you double your money. So it's a win-win everywhere. But guys, if you've not listened to the podcast this week, there it is right there. Until Friday, have a great week.